Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Okay, welcome everyone to the December podcast of the former Cormark Quantitative Fund, and we had to change the name to Corton-Aemelia. Cormark was acquired by ATB Financial recently, and that's just gone through. So we can no longer use the name Cormark. That's a thing of the past. So Amelia is the name of a small company that I've created, and the name comes a little bit from my heritage. Both of my parents were from Holland, and Amelia was the name of a Dutch warship that was part of this pivotal battle with the Spanish Armada in the 1630s, 1632, I think it was. And thankfully, the Dutch won. I guess I'm biased, but it turned the tide, and Spain kind of lost their luster and started the Dutch Golden Age. So that's where that name comes. As always, our tagline is to take the emotion out of investing, which is harder than it sounds, but we have these quantitative systems that rank stocks systematically, and that's how we build the fund. So we will talk about our little disclosures, and then we'll get into the cartoon show, as they say. So I'm Mark Deriet. I'm the founder of Amelia Capital Management Corp., an independent firm that develops quantitative models that have been licensed to and implemented by Corton Capital, Inc. Corton is the investment fund manager and portfolio manager of the Corton-Aemelia Quantitative Fund, and its underlying fund, Corton-Aemelia Quantitative Fund LP, each a related issuer of Corton. So we have our broad macro indicators, these red light, green lights that we like to talk about to try to simplify matters. And there's, frankly, heading into 2026, a lot of green lights. So had we reversed in time and gone back to October and November, a lot of those indicators on the far left, the strong camp, the green lights, were yellow. And we were looking for a bit more of a sell-off and kind of a more tactical washout, which frankly didn't happen. And then late November, the market started to dig in its heels, and these indicators slipped back to green. So it doesn't mean the market goes straight up from here, that's for sure. But if we follow, for instance, seasonal patterns, the typical sell in May and go away does tend to work better during these midterm election cycles, and the returns in general of those years are subpar. I don't lean too heavily on seasonality, but that's typically the way it has worked out. But it does tend to start off strong the first quarter. You get a weak patch, and the fourth quarter tends to be very, very strong. And then the following year of a presidential cycle is also strong. These are forecasts. We'd rather just follow the signals. So importantly, this is the global equally weighted index, 3,000 stocks. It's our favorite proxy for the market. And it gave this wobble in October, November, where it broke the short-term support for the first time in many months. And now it's breaking out to new all-time highs, and that happened ahead of the S&P. We are seeing underneath the hood a shift of leadership into international stocks versus the U.S. And I'm talking about a big picture shift. That past decade plus has been in favor of the U.S., and that's starting to turn to global markets, including Canada. This is the equally weighted S&P index that also has made a new high just before the S&P as well. So, this is important in terms of kind of a breadth proxy. but also the fact that the real mega cap stocks are no longer really leading over the near term. The Mag 7 and so on are starting to lose their luster. This is the S&P. It did not break short-term support back in November. It held this green staircase as a proprietary Bloomberg indicator. It's called a trender. The trender is your friender, I say. And the market is innocent until proven guilty above that line in the sand. That's around 6,600. The upside that we get is around 8,000. Those are determined by what's called Fibonacci extensions. We won't get into that today. But we do think you can argue there's time on your side for the bulls. So one indicator of that is the bottom clip. It's simply a momentum indicator of the S&P called an RSI. So the way we interpret it is different than most people. Most people say, well, it's oversold, you buy the market, and it's overbought, you sell it. So you can see here, for instance, in the spring of 2022, it became oversold, but that wasn't the time to buy. There's a lot more pain after that. And the first time it's able to push into overbought territory, that's actually a sign that the light switch has gone on. And we've gone back to 1896, believe it or not, and tested this for the S&P and the Dow before that. The average subsequent return over after that signal is 21%, and it lasts 20 months. So that's why we're saying time on your side for the bulls. This happened just in June of last year. We talked about the secular bull case a few times on this podcast, I believe. We've been in the secular bull camp since 2013 when the market made a new high, or you could argue, the major low after the great financial crisis in 2009. And the CAGR, when you're in a long-term bull, is 13% on average versus just 3% in a long-term bear. So this bull, we argue, is perhaps due to peak out in 2030 to 2035, somewhere in that zone, based on how long they've lasted in history. Not a lot of data points, admittedly, but that's the history that we have. And so what we did here is just did a simple regression. This isn't us making up the lines. We just, on Bloomberg, you can take the low and do a regression in time and extend it out to see what might happen. So I think you always have to have an open mind to a wide range of outcomes. We don't try to predict, but the trend is certainly still up and to the right, as they say. So if we look at the mean, which is the middle zone of these black bars, that's only around 7,000 at the end of this year. The top of the band is around 8 and the bottom is around 6. So, we could be in for some volatility this year. It wouldn't be surprising. You get on average, at least a 10%er every year. And so I'm not looking for a bear, but maybe we get to 8,000 and then there's some volatility after that. And I extended it out to 2030 and 2035, and the target is 10,700 if we're at the midpoint in 2030. And that happens to be this famous strategist in the US, Ed Yardeni's 10,000 target as well. I think it's 2029 for him, but we're splitting hairs. Point is, we're in a secular bull. The wind's behind your back from the long-term perspective. Doesn't mean you have to you can escape volatility, but this is important to zoom out and again not predict. You get all these year-end predictions by the strategists, but they're generally not not written in stone. I just show here the 74 to 2000 bull. The CAGR was 13%. The same as those typical of a secular bull, and we ended near the top of that regression in 2000, that blow-off top. In this 42 to 68, the CAGR was a little lower, 10.5%, and we ended with a bit of a thud prior to that 70s bear market. And we've shown this slide many times. Demographics is part of the story. The blue line shows millennials, the number of them that are entering their prime workforce age, which is 25 to 54 years old. That's not due to peak until 2035. And these aren't, forecasts. These are baked in the cake based on who's been born so far. And the red line shows the boomers, 1980 to 2000, and that 2000 peak lines up with the blow-off top in the NASDAQ. So let's get back to the near-term indicators here, and we like to talk about breadth. So global breadth has been quite healthy for some time. Even in the sell-off last fall, the global market was holding in way better. And that may be a tell that, again, there's shifting sands underneath the hood, that the international stocks are starting to turn up relative. I don't have the chart, unfortunately. I should have included it. I just looked at it earlier. But if you do a ratio of the world ex-US, ACWX is the ticker, ACWI ex-US, relative to the S&P, they're on a monthly indicators that are flipping to positive for the first time in 15 years or so, whatever the duration is. So global breadth remains strong. Canada, by the way, is near the top of the pack. You can see our ventures index and small caps riddled with resource stocks, and those have been in gear and driving the bus here. The other breadth measure we look at closely is in the green bars here are the percent of stocks in the Russell 3000 that are making 52-week highs, and the red bars are lows. So we are getting close to a warning sign when that red bar, the lows list, is at more than 10%. Last time that happened, the big warning sign was November 21. It was very, very quick during the taper tantrum. There was no real warning. That was kind of out of the blue like COVID. But importantly, we didn't trigger that. And we're back to a situation where new highs are expanding and greater than new lows. And importantly, we haven't seen as good as it gets. When that green bar gets to 20%, that can mark a bit of a euphoric phase where the buyers can be exhausted after that. So we're in this middle zone, but improving in terms of that breadth measure. Some other breadth indicators on the left here is the percent of stocks that have a golden cross, they call it. Just simply is the 50-day above the 200-day moving average to define a long-term uptrend. That did start to ebb into November. It was as high as 67, got to 60, now we're back curling up to 62. Typically, you get north of 80 before it's as good as it gets. So we've got room to expand. And then the shorter term breadth measure on the right, they call this a silver cross, second place, I guess, is the 20-day above the 50-day. That started to deteriorate. It peaked actually in July. So that was the kind of warning sign that might be some sort of a pullback. Now it's expanding as well. And then this is the percent of stocks above their 200-day, just is the price above the 200-day. It's a little bit more whippy. We had a big washout in the spring of 25. So is that a reset of the cyclical bull market? So yes, the market has gone up a ton off that low, but in terms of time, we don't see these blood in the streets washout levels below 15% every day. On average, the duration between those blood in the streets zones is 40 months. And again, we just got it in the spring of last year. The shortest is 15, the longest is 73 months. So again, maybe a cyclical reset of the bull back then. And then we were looking for tactical indicators to get washed out in November, and they just didn't. And now we're expanding again. So the percent above the 20-day, which is up and down like a yo-yo, you can see, we used below 20% in this indicator as a buy the dips measure. That happens on average 4 times a year. And you can see it hasn't happened since the spring of last year. So that kind of surprised us, frankly. That will happen again, obviously. But we'll monitor that every day. So volatility is another key thing that we look at. Low vol market is the characteristic of a bull, not a bear. You get these big daily swings in bear markets, and that's really settled down. We haven't seen that occur. So a stable market is a good market. And this is volatility not only for equities, but also bonds and currencies all combined. And it was perking up in November, a yellow light, but now it's back to green. Credit spreads also were starting to perk up, not a huge lift, but a yellow light. And now that's back to green. The spreads are quite tight. The credit market has an eerie way of sniffing out trouble, typically ahead of equities. And you can see that in red here is a basket of spreads, but they're inverted. So when that red line is falling, the credit guys are getting worried. The spreads are widening. There was a little bit of a divergence, if you will, with equities, which are the blue line. They were holding up better. And we don't like to see that because you can see in the past, the credit market gets bearish ahead of equities. This is the Dow, but you can use the S&P and so on. And in fact, the equally weighted equity index does track that credit spread indicator closer. So, the signal from the S&P and so on can be the wrong one when you're late in the game. Commodities, very important for Canada, obviously. This is the Bloomberg Commodity Index. It's emerging from a 3-year sideways trading range, a base, whatever you want to call it. So that's an important inflection. And, it's not just gold. Copper has had a big move and so on. The one that hasn't yet is energy, obviously. So we look at breadth for everything we do. And here, the blue line is a breadth measure of commodities. How many are in a cyclical bull market? Not surprising, that tends to follow the economy. So the red line is just the manufacturing PMI for the US as a proxy for economic growth. It has, with the exception of a little perk up here, been stuck in the muck below 50 in contraction zone for about 3 years. But, that commodity index is breaking out. The breadth hasn't quite done much yet, but, this suggests that maybe better economic times are ahead, and we can get a cycle, with a nice industrial cycle, where that red line rises and the commodities have a nice cyclical bull. This usually portends a move into higher beta stocks versus quality stocks. And then, it gets as good as it gets and things roll over. So in the spring of 21, not only did commodities and breadth peak, but the ratio of high beta to quality stocks in general peaked. You might recall back then everyone and their dog was opening up a SPAC, for instance. So here we've got a measure of ranking the commodities. So precious and base metals are at the top. Oil is still down at the bottom. Typically, precious and then base go first and energy follows. So we're on alert for that, but it hasn't really happened. We need the proof in the pudding. So everyone is on to the gold trade here, obviously, and it got very, very extended again in terms of the momentum. It is correcting more in time than price. And we had noted many times that all the pullbacks since breaking out in late 23 had tapped this blue line. The dark blue line is a 20-week or 100-day moving average. That's around 4,000 now and rising. It could still pull back there. And then, just basically it's marking time, though, from these overbought conditions. Silver has gone parabolic, and it has started to correct. We had a nice weighting in silver, and we've reduced that dramatically. Just, the risk reward when things go off the charts, literally. We like to embrace strength, but at some point you've got to feed the ducks. Copper has had a big breakout, and this base targets $8 plus longer term. Short term, it has started to correct just this week, and after hitting about 620 or so. So this chart's a tiny bit old, but importantly, we see the potential for a big mean reversion into base metal stocks versus gold stocks. Doesn't mean gold stocks have to go down, but this is the ratio of an ETF of base metal stocks, PICK, PIC is the ticker, versus gold stocks, GDX. And it's eerily in the same time zone as its bottom the last three times in around the COVID period in early 16 and in 2012. And these happen to be major turns in the economic cycle as well. So pointing to, perhaps better economic times globally ahead. And this ratio has been, cut by 2/3 from the peak. So, you could get a significant outperformance in base metals potentially. So we've increased our base metals exposure over the past several weeks. Currencies. So this is a basket of risky versus safe currencies, and a little bit of a wobble there, a yellow light in the fall, and that's turned back to green. The Canadian dollar has held this huge line in the sand around 68 cents. It's got to get above 73 or so to make a new reaction high. There's all sorts of resistance, 77. 83 to me is a line in the sand that's very important. That is these Fibonacci retracements. All that means is, it fell from a buck and change down to 68 cents. It retraced 38% of that bear, and that's a Fibonacci level. And it's hit its head up against that a few times. You can see 83 cents. If we're able to big picture, break out of that, then we're talking about a commodity super cycle. But I think that's a key chart to watch for a signal of that super cycle confirmation. I don't have the long-term chart of the Bloomberg Commodity Index. It's coming out of a 3-year base, as I mentioned, but it's still well below this 38% retracement level off of its peak back in, I think it was 2008. Rates. So we think the market drives the bus and not the Fed's, the Fed funds here. The red line is the Fed funds target. The blue line is the 2-year yield. So it's really, you can see both up and down at turns. The Fed just listens to the market. They definitely talk a lot, but they listen more. So importantly, the 2 years only baking in one more cut. So have we pulled off the easing cycle without a recession happening? If that 2-year yield collapses from here, it would suggest that the economy is a lot weaker and the Fed will have to cut more. But now they're kind of neck and neck, and the Fed is not behind the curve, if you will. And whenever you start this easing cycle, you have to ask yourself why, and it's generally because there's economic slowdown. Half of the time, 4 out of 8 times in the past, you've got a recession, and the other half ended in a kind of growth scare or just a slowdown. And the S&P, the paths are diametrically opposed. You can see looking out in time, obviously no recession, much better returns. So the good news is we don't see evidence of a recession still. We've talked about these charts before. The blue line is hard data. It's what people are actually doing versus what they're feeling, which is the surveys. The PMI here is in black, and there's a Conference Board leading economic indicator that's in red. They called a recession in the middle of 2022, but what people are actually doing is fine. So this has things like gasoline sales, electricity usage, and retail sales, and so on. No recession there. And then the labor market continues to cool, but not collapse. So it got really, really tight post-COVID, historically tight. You can see this is in deviation terms, 2.3 deviations above the mean. It's not collapsing like we saw during COVID or the GFC. It's definitely slowing. So as long as it's maybe controlled, we'll be okay. And earnings will be okay. So this red line is the consensus earnings for the S&P. It's now 311. And the blue line is the year-over-year rate of change at 14%. A devil's advocate would say maybe the earnings bar is now set high for this coming quarter, which is a risk. The prior quarter, the earnings bar was set fairly low in terms of people having cut estimates aggressively ahead of the quarter, whereas it's the opposite this time. We look globally, and estimates have risen quite a bit. So, that's one risk to consider. But again, no recession is the outcome from that chart. Our risk appetite, Baker's dozen of 13 risk trades. The red line here shows how many are in gear, and the table shows in green are good and red are bad, the usual. There's only two that are weak, copper to gold and Bitcoin to gold. And Bitcoin to gold is a concern. We'll get back to that in a second. This is the basket of risk trades all put into one chart. And again, in November, it was starting to look dicey, and it's coming back to life. It's still less exuberant than the equity market, and that's largely being drawn down by this Bitcoin to gold ratio, which is in red here. And the black line is the triple Qs. So you can see they tend to trend together, and there's this huge alligator kind of mouth opening up here between the Qs in black and the Bitcoin to gold in red. We looked at this historically, and the bottom left clip here shows the correlation between the two. And when it turns negative, which it has, the Qs have peaked out 6 months after the fact. So it's an early warning signal that has fired. So it's not as if, everything is green. This is one of our key concerns. We'd like to see Bitcoin. It has been stabilizing. We'd like to see it get back above 94, and I think 100,000 roughly is the level. Factors. So the key ones that we look at is this ratio of beta to low vol. In the tariff tantrum, the momentum of it got as bad as COVID. And again, blood on the streets was happening in that period and so on. So that was the obviously low risk entry. We had a huge snapback, and we're surprised that it kept going because the momentum was like here, similar to after COVID, and then you got a 20% correction. But this time it just kept on going. That was a bit of a surprise to us. But new highs, embrace strength. This is sector rotation. So this is equally weighted discretionary, industrials, and tech in the numerator, staples, healthcare, and use in the denominator. So yeah, this gave a wobble in November. Now it's turned back up, and it's making new highs. So here we have breadth by sector in North America. This table is sorted by our long-term breadth score. And we see gold at the top of the list. It's still in the sunshine. Our short-term measure is on the far right, and we plot them out in this scatter plot. Gold strong, energy losing it short-term, financials very strong, healthcare, that's mainly a US story, discretionary, materials and industrials are improving. Tech is at best neutral. You can see the breadth there is actually not great. Software stocks have been very, very weak versus semi-strong. But if you just sit back and look at this schematic, it shows a risk-on world. REITs and staples are very weak. Utilities are weakening. Communications aren't great. Tech, is cyclical, but that's the one cyclical area that's the weakest. And healthcare is the one defensive area that's the strongest. We have this bottom-up TSX momentum model that we follow every week. We update it. And banks have been at the top of the list in Canada for quite some time. So we give each stock a 0 to 2 times its benchmark weight and simply sum them up and force it to 100%. Banks, 43%, basically double weight the index that ranks the top. And golds have been kind of battling it out with the banks for many, many months on that ranking. You can see that potentially here as well. Golds, 1, 2, 1, 1, 1, 1, 1, 1 for a long time. Financials have dropped to number 3, but you can see they were kind of 2, 2, 1, 1, etc., battling it out with golds. At the bottom of the list, a lot of defense, utilities, REITs, pipelines. Industrials in Canada are not great because of the big rails. There's some stocks that are good there, but it's a mixed bag. But in general, cyclicals at the top, defense at the bottom. We look at this rotation from the stock point of view as well, this sun rain chart, embrace strength in the upper right, fear weakness in the lower left, and look for fresh money ideas that are migrating out of that rain cloud. And we have been adding to some of the stocks in the upper left, things like Manulife we've held for a while. TFI is one we recently added. And then we go hunting in our quant stars list. So these tick all of our boxes from both fundamental momentum and price momentum screens that we have. So in terms of the fund, ended the year kind of neutralish exposure, 94% net exposure, shorts are 17%. The beta around 0.8. In general, we run the beta a little bit lower. We want to try to capture as much upside as possible, but we're always looking over our shoulder for downside. So, that's the way we tend to manage the fund. We will take big swings at times at sector rotation and so on. But overall, the beta of the fund since inception, which is not a heck of a long time, obviously, we just started investing in middle of May. The beta has been about 0.6. We have more big cap exposure now. We are leery of liquidity risk and so on. And there's just a lot more big caps that have sprung up in our work recently. And our active share, therefore, is lower than normal. In terms of sectors, the biggest overweight's materials. We've had big move in big exposure to copper. We have peeled some of that off just recently, given the big run, and discretionary names also, so a more cyclical bent. Underweight are REITs and technology. In Canada, there's just not a lot of tech stocks that hit our buy screens. Here are some recent trades. So financials is a big weight for us as well, and it's a huge weight in the market, as you know. Alaris is a mid cap stock, which has a very strong quant rank, number 69 overall, of about 700 stocks. That's the yellow line, the history of it on the left chart. And the price is broken out to multi-year highs here recently. It's not a very zippy stock, but it's kind of a steady one that's stronger quant and breaking out technically. We switched out of Laurentian Bank. We had it in our value picks, and thankfully it was taken over. Obviously, we didn't predict that, but it was trading at like half times book. And we've put it into Equitable. The valuation on our work is 3 out of 10, 1 being the cheapest, 10 the most expensive. And then they did this deal recently, and the stock has broken out. Silver, as I suggested, we've reduced our position pretty aggressively there. We had a double bull on silver, the commodity itself, SLVU. We've taken that off, and we've reduced our exposure to SILJ. We had some individual stocks as well, which we've fed the ducks. So the performance last month, we were up 0.5% in December for the F class, and since inception, again, very early days, we're up 21.4% in the F class net of fees. The performance last month, the top contributors were USA, which is a small silver name. We're not there right now. SLVU, I mentioned, and the Laurentian Bank on the takeout. IMO, Trisura, and HPS is an industrial. Those are the biggest negative contributors. And again, our beta since inception is 0.62. So, we're aiming to hopefully beat the market returns over time. We're a little bit behind the TSX in terms of total return with a much lower beta. So we leave it at that. If there's any interest in the fund, if you're not there already, please reach out to myself or David Jarvis. He's the founder of Corton. And any existing investors, I'm happy to take any questions at your leisure. Take care and Happy New Year, everyone. Bye-bye.